The thesis that the gold stocks were broken is one that was really a 2024 story. And I wrote about it just over a year ago, arguing that they weren't broken, but that as my mentor, Rick Rule, taught us so well, the gold producers in the last big gold bull market managed to turn a sevenfold increase in the underlying commodity into an increase in negative free cash flow. And I went and charted that. It's true. So the intelligent investor, assuming there are two or three left still alive, it wouldn't be wrong for them to hesitate before saying, oh, gee, gold's up, gold stocks should go up. The last time, they turned it into greater negative free cash flow. Why would you buy that business? Or as my other mentor, Doug Casey, says, it's a crappy choo-choo train 19th century industry. Why would you invest in that today if your most recent experience with it is a dramatic underperformance? So flash forward to this year, and not only do we have the higher gold dollar exchange rate. I don't like to call it the gold price because in my mind, gold is money. So it's a Forex question. The higher gold dollar exchange rate, it's not just that has pushed up the miners. The miners have actually started delivering. Agnico, as you mentioned, known for excellence of operations, it actually was outperforming even last year. And the other ones that have problems, not so much. And that kept the GDX underperforming. Well, this year, even last year's underperformers are benefiting from the margins, and some of them are actually getting their act together. And so, it makes sense. The business is actually delivering, and so those people who previously said, "Well, the gold miners, they flubbed it last time. They dropped the ball." Well, this time they're actually running with the ball. There's a rational basis for saying that. Well, now it makes sense. And then, of course, the food chain, the trickle-down theory, that actually does work in the mining space. We've seen this repeatedly. So I will push back a little bit on my mentor here and say that the obviously better companies have responded with gusto here. So it's really difficult for me to look the audience in the eye and say, yeah, never mind $3,300, $3,400 gold in all-time highs, not just 52-week highs, but all-time highs in a stock like Agnico or something like that. Just buy it. It'll be fine. There is opportunity for correction. And the idea is to buy low, sell high, not to buy high and hope to sell even higher. So as much as I love a company like Agnico, I wouldn't buy that today at an all-time high or very near to that. I would look for something that is legitimately still overlooked. And this requires due diligence. This is a stock picker's market now, is basically what I'm saying. I wouldn't buy an ETF. I wouldn't buy the GDX or the misnamed GDXJ. I would look for something that is legitimately bringing value to the market, which hasn't caught on yet. And those do exist. They're out there. But there are ones that you can't say, oh, it's cheap, so that's an overlooked gem. No, there are stocks that are cheap and they deserve to be cheap, right? Lifestyle companies and that sort of thing. So again, caveat emptor, buyer beware. This is a stock picker's market. But if you're willing to do a little work, and hey, if you want to make money, you should be willing to do a little bit of work. Maybe a lot of work. I do think that there's still, I'm agreeing with Rick, there's still opportunities in the gold and silver stocks, but I do think it requires effort here, no dart throwing.
Well, I would respond to Lobo by saying it's always required effort. And what he says about the sector as a whole couldn't be more true. There's probably 1,000 public companies worldwide that purport to be in the gold space, but most of them only have gold as a component of the name on the share certificate. If a commodity rises that you have none of, it shouldn't impact your basic values. And the great majority of the purported gold mining stocks will ultimately return to their intrinsic value, which is zero. Investors make fun of sovereign issuers for inflating away the currency, but there's no industry in the world that's better at inflation, which is to say printing phony paper, than the gold mining industry. That disguises the fact that there are qualitatively better companies now than there were in the decade 2000 to 2010. Remember that the most flagrant abusers in that epoch were allowed to pursue other employment opportunities, hopefully in other industries. I would argue further, as an example, with Agnico Eagle, and we've done the work. If you do a net present value calculation on their future cash flows at $3,200 gold and compare it with the net present value of future cash flows that existed 18 months ago when the stocks were half as high, they're actually cheaper today than they were 18 months ago on a net present value basis. Both Lobo and I have the experience, we have the courage, and we're willing to do the work. So we can go further down the feeding chain than most people do. However, if we're talking to a broad audience, which I know the VRIC has, the truth is that most of the population under-owns the gold trade. And just capturing the beta, just capturing the amount by which the gold market outperforms the broad market in a gold bull market, argues that investors who aren't willing to do the work, who can't suffer volatility, too much volatility, and can't suffer real risk, need to be in the best end of the market. Bull markets follow very, very predictable patterns. The metal, the best of the best of the rest. The junior producers, the developers, the explorers. That's the way it works. For myself, I'm moving way, way, way down the value chain. I'm trying to get as far away from the institutional investors, from the traders, from the ETFs, as I possibly can, so that I can acquire large positions in companies that will be acquired and added to the index. That's the way the game works. But this is a game that requires a lot of work. And I have learned at my conference and your conference that most investors are unwilling to do the work required. Most investors would prefer to feel as opposed to think. For them, they need to be in very, very high quality names.
Let's start with a bit of humility, because this business will give it to you whether you want it or not. One of the most repeated criticisms I've heard lately, and it's echoed across newsletters, Twitter feeds, and bars full of junior mining speculators, is that gold stocks are broken. People say it like it's some gospel truth, like it's carved in stone. But if you scratch beneath the surface, what they really mean is this. They bought gold stocks at the wrong time, didn't understand the business model, and now they're mad. But let's take the emotion out of it and actually look at what's happening. Because if you're paying attention, you'll know this isn't a story of failure. It's a story of transformation. Back in 2024, when that narrative started really gaining steam, that gold stocks were doomed to underperform, I wrote that it simply wasn't true. But I understand where it came from. The last big gold bull market, from 2001 to 2011, saw the metal go up sevenfold. That's huge. But do you know what the producers did with that windfall? They turned it into negative free cash flow. Let that sink in. The commodity goes up sevenfold and the miners still manage to light money on fire. That's not just bad execution, that's a master class in capital destruction. And people remember that. They should. So it's no surprise that the intelligent investor, and I assume there are still a few left, would pause. They look at $2,500 in gold and say, "Fool me once, shame on you." And fair enough. If you experienced that era, if you watched companies raise capital hand over fist, dilute shareholders into oblivion, and buy marginal assets at the top of the cycle, then of course you're going to be cautious now. That's not cynicism, that's pattern recognition. As my friend Doug Casey often says, the mining business is a 19th century choo-choo train that never really figured out how to run on time. It digs holes in the ground, shovels rocks, and burns money. So why would anyone invest in it? Well, here's why. Because today the story's different. The gold-dollar exchange rate, what some mistakenly call the price of gold, is at all-time highs. And unlike the last cycle, the miners are not squandering the opportunity, they're actually delivering. Let that sink in for a minute. The margins are better, the balance sheets are stronger, the management teams are, believe it or not, showing discipline. Even some of the laggards from last year have started getting their act together. Agnico Eagle, for instance, has been nothing short of excellent. They were outperforming even in 2023 when the rest of the GDX was dragging its feet. But now even the previous underperformers are benefiting from the widening margins. And more importantly, they're managing those margins intelligently. That's a change. That's what gives this market legitimacy. There's a rational basis now for believing that gold equities can perform in a rising metal environment. Because they're not just piggybacking on price, they're earning it. They're operating. They're generating free cash flow. Some are even returning capital to shareholders. What a concept. But let me give you a word of caution. That doesn't mean you should rush out and buy the GDX. I'm not saying throw darts at the board and hope something sticks. This is a stock picker's market. You need to know what you're buying, why you're buying it, and what it's worth. This is not the time to own lifestyle companies with $10 million in the bank and a newsletter sponsor budget that exceeds their drill spin. This is the time to own businesses. There are names out there that are still overlooked, still cheap, but they're cheap for a reason. Some are cheap because they're garbage. Others are cheap because the market hasn't figured it out yet. Your job as a speculator is to know the difference, and that requires work. It requires due diligence. It requires the courage to say no to 90% of what you see. Now let's talk about the food chain, because there is a hierarchy in how this bull market unfolds, and it always plays out the same way. First, the metal moves. Then the best of the best respond. Companies like Franco-Nevada, Wheaton Precious, Agnico Eagle. Then as those valuations get stretched, capital flows down to the next tier, the best of the rest. Mid-tier producers, near-term developers, then the juniors, then the explorers, then the moose pasture. The smart money rides this wave early, the dumb money chases it late, and the dumb money always ends up holding the bag. So where am I looking? Way down the chain, as far away from institutional capital and passive ETFs as I can possibly get, because I don't want to pay 20 times cash flow for a name that every pension fund already owns. I want to own the company that gets acquired by that name. I want to front-run the index. That's where the alpha lives.
Areas of the commodities sector at present do you think presents the greatest value proposition, and how are you positioning yourself to capitalize? Lobo, I'll start with you.
I'm going to have to go with copper. That's been my top call for 2025. And people have been wrongly congratulating me on that because copper hit an all-time high earlier this year, but not for the reasons that I gave. So maybe you should stop listening to me then. But I think all those reasons I gave are still in front of us, and going into that from a higher cost base or a price level, I think that just adds to the upside. And the thing that I like about, I'm bullish on many things. I could, other metals and minerals are high on my list. But the thing that I like about copper is that it really is straight. The structural supply constraints here are so real, so big. That pipeline is so close to dry for years and decades to come. It's just an extremely strong thesis. And I think we're getting to that push comes to shove moment. My only concern is in the very near term, we still have plenty of trade war issues, actual war issues, Trump shock ahead to deal with, and Dr. Copper is economically sensitive. So I think there's potential for near-term weakness, which I would absolutely see as a gift from Mr. Market, a buying opportunity, and I am saving up cash for that.
And really quickly before we move on, why did copper hit all-time highs, and why did that not align with
for the
thesis?
wrong reasons? Trump didn't even announce a copper tariff. He announced, he signed an executive order. We're going to look at copper. We're going to study it. Oh, great. You remember when they studied uranium? That took years, and then they did bupkis. Sorry, but the fact is it was actually Biden that implemented the Trump study group idea of uranium, of establishing that uranium reserve, and funded it, or started it anyway. So, a study group doesn't excite me. And maybe it's a coincidence, but that's all that really happened in the market at that time. What's happening now, I think, is more real. It's got more of my attention. I'm still worried about Dr. Copper in the nearest term, but when the LME stocks go, way down, and China's having to, trouble getting its smelters to work right. They're very excited because they just got to zero smelting charges. That tells you something about the market. So I'm really, really very keen, and I don't claim to be able to time the market. I just have this feeling, though, that the time to buy is in front of us rather than behind us. If I'm wrong, I'll still have years, I think, and decades to make money on this trade. If you're very patient and you can handle the kind of drawdowns that have resulted in Rick having less hair than me at this time on the way. Rick will tell you all of my big wins have had 50% drawdowns on the way. If you can handle that, and you think copper is likely to, the bottom is behind us, then don't wait for me. Go ahead. I think that is so solid that I would go ahead. But it's Dr. Copper. I just can't get it out of my head that the other shoe is yet to drop on the retooling of the American economy that the president is trying to ram through, and that will have consequences that I think will create a buying opportunity.
Let's get straight to it, because this is where things get serious. We've covered the shift in fundamentals, the historical sins of the mining sector, and the reasons why this time actually looks different. But now we need to talk about the capital flows. Because if you want to get in front of the next wave, you have to understand how money behaves, and more importantly, how it migrates. When you enter a gold bull market, capital doesn't flood in all at once. It trickles, it sniffs around, It tests the temperature. First, you get the true believers, people who never left. Then you get the contrarians who see the technical breakout and remember how this story goes. But then comes the big money, the pension funds, the sovereign wealth, the generalists. They don't rush in. They don't buy on day one. They wait. They want confirmation. They want validation. They want momentum. And here's the key point. Momentum has now arrived. Look around. Agnico Eagle isn't just up. It's breaking all-time highs. Royalty companies are re-rating. You're seeing inflows into precious metal ETFs. And more importantly, you're seeing institutional desks dust off their gold coverage notes. That's when you know something's shifting. The juniors aren't quite catching the same bid yet, but that's coming. That's always how it works. Money flows up first and then down, like gravity, but with dollar signs. Now let's take a step back and think about why that happens. Because capital is scared of underperformance, scared of volatility, and most of all, scared of being first. Nobody wants to explain to the investment committee why they bought silver juniors while Nvidia was making all-time highs. But now that the market is rolling over, and it is, those conversations are starting to change. We talked in part 1 about the deterioration in equity breadth. That hasn't improved. If anything, it's worse. The major indexes are being held up by a couple of overextended names, while under the hood, the rest of the market is quietly bleeding out. And when the top names finally break, and they will, capital will scramble for alternatives, and there aren't many left. Gold will absorb that capital first. It always does. But then comes silver, then the miners, then the developers, then the juniors. And for those of us already there, positioned early, that's when the asymmetry hits. But let me say something uncomfortable here. Not all juniors are going to rise. In fact, many of them will go to zero. That's not a pessimistic take, it's just math. There are over 1,000 companies globally that claim to be in the gold or silver space. Most of them couldn't find a gram of gold with a treasure map and a metal detector. They're lifestyle vehicles, dilution machines. The only thing they mine is shareholder capital. As I've said many times, the mining industry is the greatest counterfeiter of equity the world has ever seen. More dilution, more private placements, more strategic reviews that go nowhere. That's why I say this is a stock picker's market. Not every rising tide lifts all boats. Some of them are tied to the dock, and others have already sunk. So how do you separate the signal from the noise? You look for companies that have assets, real assets, projects with known resources, pathways to production, clean capital structures, and leadership that actually owns stock. Not options, stock. That's where alignment comes from. If the CEO isn't buying on the open market, why should you? And here's where it gets exciting. Because despite the rise in the gold-dollar exchange rate, and I still won't call it a price, many of these high-quality names are still trading at a fraction of their net present value. That's not hyperbole, that's math. Let me give you a concrete example. Take Agnico Eagle. We've done the modeling. If you plug in $3,200 gold, and yes, I believe we're heading there, then the present value of Agnico's future cash flows explodes. And guess what? Even after the stock has doubled, it's still cheaper today on a forward NPV basis than it was 18 months ago. That's the power of a re-rating driven by rising margins. And it's not just Agnico. There are a dozen other names in the mid-tier space that are now generating real free cash flow, trading at single-digit earnings multiples, with long-life assets and production growth ahead. These aren't hopes. They're operating businesses. And if you're tired of the guesswork in tech, or the leverage in real estate, or the political headwinds in energy, then these names offer something that's becoming extremely rare: visibility. But let me be clear, this is not the time to blindly chase high-flying names. If a company's already doubled on air, but hasn't drilled anything or advanced a project, that's not value, it's risk. There's nothing worse than paying momentum prices for a narrative with no substance. So ask yourself, what's the real margin of safety? What's the plan? And who's executing it? If you don't have answers, you don't have an investment. You have a lottery ticket. Now, what about those who say, Rick, I hear you, but I don't want to do all that work? Fine. Then own the best. Own Franco-Nevada. Own Agnico. Own Wheaton. Capture the beta, because even owning the best of the best in a gold bull market will deliver serious outperformance. But don't fool yourself into thinking that just because you own the GDXJ, you're diversified. That ETF hasn't held a real junior in years. It's a mid-cap fund with a bad label. The other mistake people make is trying to time their entry, waiting for a dip, waiting for confirmation, waiting for the perfect setup. Let me tell you something. In this sector, perfect setups don't last. When silver broke out past $35, it didn't politely pull back to $30 so you could get in. It surged past $37 and said, "Catch me if you can." These markets don't give second chances. They give tests, and those who pass are the ones who are prepared, not the ones who try to be perfect. Now let's zoom out. Think about what the macro environment is telling us. Debt levels are unsustainable. Fiscal policy is a circus. Central banks are trapped between inflation and deflation, and their only real tool is confidence. When that confidence breaks, and it will, capital will seek safety. Not in treasuries, not in euros, not in Swiss francs, but in gold, and eventually silver. We've already seen central banks buying record tonnage of gold. That's not speculation. That's survival. That's governments preparing for a post-dollar world. You think they're buying crypto? They're buying gold. And they're doing it quietly. That's your cue. I'll tell you a story. A few years ago, I was speaking with a fund manager who told me he didn't believe in gold. I said, "Fair, but what happens if your base case is wrong?" He shrugged. I said, "Then you'll own a lot of fiat and no insurance." He nodded slowly. The same logic applies to mining stocks. You don't need to go all in, but you need to own something. Because when the re-rating hits, when silver blows through $50 and gold pushes toward $3,000, it won't matter what your intention was. Only your positioning will. I want to wrap up with a practical takeaway. This market is not about narratives anymore. It's about execution. If you're in this game, know your companies, know their balance sheets, know their assets, know their dilution history, know their management, know their catalysts, and above all, know why you own what you own. If you're not willing to do that work, then buy the best and forget the rest. But if you're willing to dig, if you're willing to think like an owner and not a trader, then this is your market. This is your cycle. There are deals out there right now, quiet, boring deals, that could turn into 5x, 10x, even 20x returns. Not because of hype, but because they've got ounces, a pathway to production, and nobody's watching. Yet, but they will. They always do. And when they show up, the price will be higher. So be early, be brave, be smart, and be ready. Because we are now entering the part of the cycle where fortunes are made. Not by guessing, but by knowing. Thank you for sticking with me.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.